Today, we are diving into what Tom Lee, Fundstrat's head of research and chief investment officer, had to say on CNBC's The Exchange about the markets, crypto, and the future of equities. According to Tom, crypto's market makers are crippled right now, but once liquidity returns, stocks could rip higher. In this video, I'll first show you the clip of Tom Lee on CNBC, and then I'll break down my own reaction to everything he said. After that, we'll go even deeper with an in-depth analysis of 3 of the cheapest AI stocks to buy right now. If you only watch one video today, make sure this is the one, and watch it all the way through. Hit that like button, let's aim for 1,000 likes on this one. Share the video, leave your thoughts in the comments, and subscribe to the channel so you don't miss the next important financial investing update. Let's jump in and hear what Tom Lee has to say.
All right, so Tom, you've heard what Steve had to say. This is, by the way, not unusual for Nvidia, is it? Nvidia, the good folks at Bespoke, your team, you've recognized that Nvidia will often have these kind of wild swings following earnings, but what is your take right now on these markets?
Well, I think I'm going to kind of add to what Steve said. You know, I think the crypto market has been limping along since October 10th, because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Well, that was the point that my very, very smart team behind me, we put together for the top of the show, which was showing that Bitcoin turned down today before the market did. All right, take us back. So October 6th, I think it was October 6th or 7th, Bitcoin hit 125,000. Yeah, a couple days later, it was still around 120,000. Now, obviously, Bitcoin's at 86 and change. So what specifically occurred on or around October 10th that would lead us to where we are now on what, November 20th?
Yeah. Well, Steve actually pointed this out. There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. On a specific exchange, a stablecoin's price varied from other exchanges. Stablecoin should stay at $1. It dropped to 65 cents. But that only happened within the exchange quotes, within this exchange because of liquidity. That triggered an ADL, an automatic liquidation across many accounts. It wiped out, as that spread across other exchanges, right? Because liquidations cascade. Almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
So who is behind this? Like, who's the they in the market makers and they got hit? Who's the they?
Well, you know, Brian, I am aware of names, but because I'm not someone who wants to name names, I think what you should keep in mind is that this error is actually essentially a bug, a code error, because I think in retrospect, they would have pulled pricing from across exchanges to set the price for that stablecoin rather than relying on internal quotes. But this has resulted in a lot of market makers and traders having less capital. And as you know, as crypto prices drift lower because trading volumes drop, they need to then have more capital available, which means they shrink their balance sheet further. So this is then that reflexive weakening.
I want to go back to this point, Tom. I hate the term glitch. I can't stand the term glitch because, things go down at the airport and they say, well, a glitch clause, your flight did not take off. That's not a glitch. That's more than a glitch. It's a word that is used to describe pretty serious automation issues, software problems, crashes, for some reason that they try to minimize. Is this some kind of a software bug that's causing part of this? I'm trying to follow exactly what you're hinting around about.
Yeah, I mean, Brian, it is. I mean, for instance, in 1987, portfolio insurance was the, quote, glitch. And that triggered the cascade in 1987. And so the industry learned and then never offered that again. You know, in 2009, it was really the collateral wasn't secure in real estate in these packaged subprime mortgages. Now, the industry learned and they recoded that. I'm talking about Wall Street, but then regulators came in and like overregulated. That was the negative effect of that. In crypto, this code of ADL and the way they pull prices is never going to happen again. The good news is we're not going to have overregulation in crypto, but now we have to deal with that liquidation effect. 2022 was a big liquidation, and it took 8 weeks. But that is kind of, you're right. It is the nature of DeFi where there is going to be code and there's going to be an error found. And you said it, leverage is what's dangerous. And so investors should not be using excess leverage in crypto.
So, right from the start, Tom Lee steps in after Steve Sosnick finishes speaking, and he immediately connects the current market action to something that happened back on October 10th. According to Tom, that day delivered a major negative shock to the crypto market, and he thinks what we are seeing in the stock market right now looks like an echo of what happened back then. The key point he makes is that the October 10th event was not just price movement, it was a liquidation so powerful that it actually crippled the market makers in crypto. This is important because, as Tom explains, market makers are basically the central banks of the crypto ecosystem. They keep the system liquid. They supply the ability for buyers and sellers to transact. And when market makers get hit with a loss or a hole in their balance sheet, everything starts to break down. They do not have the luxury of sitting still. They have to reflexively shrink their balance sheet, trade less, reduce exposure, and if prices fall even more, they are forced to sell even more. It becomes a downward spiral. Tom believes that the drop we have been seeing across crypto since October 10th is not random weakness. It's the result of these damaged market makers slowly trying to repair themselves. He even reminded the audience that back in 2022, when we had a similar liquidation wave, it took 8 full weeks before things stabilized. And right now, in this cycle, we are only 6 weeks in. That is why Tom agrees with Steve that Bitcoin and Ethereum have become something of a leading indicator for stocks. They are flashing the signal first, because the forced unwinding is happening in crypto before it spills over into equities, and we saw that in real time. The host even pointed out that Bitcoin turned down earlier in the day before the stock market followed. Tom is saying that is not a coincidence, it is structural. So then the host asks a key question. What exactly happened around October 10th? Because Bitcoin had just recently hit 125,000 and was still around 120,000 shortly after. Then suddenly it collapsed all the way into the 80s. Tom goes deeper here and explains the core of the problem. He says a lot of processes in crypto are automated. One of the most important ones is something called ADL, which stands for automatic liquidation. Think of it like a margin call that happens instantly if the value of your collateral drops. Now here is where things get wild. A stablecoin, which is supposed to stay at $1, briefly dropped to 65 cents on one specific exchange. It did not drop everywhere, only within that exchange's internal pricing system. But because their automated liquidation system relied on that internal price instead of pulling prices from across multiple exchanges, it created a sudden and massive liquidation wave. And that liquidation wave cascaded across platforms like dominoes. According to Tom, nearly 2 million accounts were wiped out within minutes, even accounts that were profitable right before the crash. That gives you an idea of how fragile the automated structure of crypto can be. Now the host asks the obvious question, who is responsible for this? Who are the players that took the hit? And Tom admits he knows the names but refuses to call them out. Instead, he frames the whole thing not as a conspiracy or malicious action, but as a code error, a bug in how the platform pulled pricing data. He explains that if they had pulled stablecoin prices from multiple exchanges, the ADL trigger would never have happened, but because they relied only on internal quotes, they set off a liquidation that spiraled far beyond what anyone expected. Now here is where Tom makes an interesting comparison. The host complains about the word glitch and says the industry uses that term to downplay serious failures. Tom agrees, and he compares this ADL issue to past financial events. He brings up portfolio insurance in 1987, which exacerbated the crash. He points to 2009, where collateral backing subprime mortgages was not properly secured, which almost brought down the global financial system. Those were structural issues that forced industries to rewrite their rules. In crypto, he says, this liquidation mechanism will be rewritten as well. It will not happen again in this form. However, the damage that already occurred is real. And now, just like in 2022, market makers are limping forward, operating with reduced capital, shrinking their balance sheets, and reacting to lower trading volumes by restricting liquidity even more. That reflexive effect, as Tom calls it, is why crypto has been drifting downward for weeks. Not because demand disappeared, but because the plumbing of the system is clogged. And that is the heart of Tom Lee's argument. He is not saying this is a fundamental collapse. He is saying it is a liquidity event driven by a software bug that triggered automatic liquidations. The crypto market is still healing, and until it fully flushes out, volatility is going to continue. But he also hints that unlike 2009, there will not be heavy-handed overregulation. So, in his view, once this liquidation cycle completes and liquidity returns, the recovery could be powerful. That is the full picture of what Tom Lee is explaining. It shows the hidden mechanics behind the volatility we have been seeing, and it makes clear why crypto moved first before stocks felt the pressure. It also gives us insight into how fragile automated systems can be, and how much influence market makers really have in this space. This was a dense interview, but when you break it down, Tom Lee is essentially saying this market action is the fallout of one major automated mistake, not the beginning of a structural collapse. And once liquidity returns, the environment could look very different. Let me know what part of his explanation stood out most to you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 cheapest AI stocks to buy now. First up is Advanced Micro Devices, ticker AMD, a company that's gone from underdog to serious AI contender. For decades, AMD was often seen as the scrappy challenger, always in the shadow of larger rivals, but in recent years the company has completely rewritten its story, emerging as a force to be reckoned with in the world of high-performance computing and artificial intelligence. AMD's CPUs and GPUs have long battled for market share, but now they're targeting the data center, the heart of the AI revolution. Data centers are the digital backbone of our connected world, powering everything from cloud computing to advanced AI models. AMD's focus on this sector is no accident. It's where the next wave of technological transformation is happening. AI needs massive computing power, and AMD's Instinct MI300 series is challenging the old monopoly with high performance at a competitive price. These chips are designed specifically for the intense workloads of machine learning and deep learning, offering a real alternative to the dominant players. The MI300 isn't just about raw speed, it's about efficiency, scalability, and making AI accessible to more organizations. Major tech giants are already adopting AMD's AI chips, signaling real momentum. Companies that once relied exclusively on a single supplier are now integrating AMD hardware into their infrastructure, diversifying their options, and reducing risk. This shift is a testament to AMD's growing reputation for reliability and innovation. The total market for AI accelerators is projected in the hundreds of billions, and AMD only needs a slice to see explosive growth. As AI adoption accelerates across industries, from healthcare to finance to autonomous vehicles, the demand for powerful, efficient chips is skyrocketing. Even a modest share of this market could transform AMD's financial future. Under CEO Lisa Su, AMD has transformed into a powerhouse with a clear roadmap and relentless R&D. Lisa Su's leadership is widely credited with orchestrating one of the most impressive turnarounds in tech history. Her focus on innovation, execution, and strategic partnerships has positioned AMD at the forefront of the AI hardware race. Their strategy: offer a viable, cost-effective alternative, forcing the market to pay attention. By delivering performance that rivals or even surpasses the competition, often at a lower price point, AMD is making it harder for customers to ignore their products. This approach is shaking up the status quo and driving healthy competition in the industry. For big tech, relying on a single supplier is risky. AMD is now the essential second source, ensuring supply chain stability. In a world where chip shortages and geopolitical tensions can disrupt operations overnight, having a strong alternative like AMD is more important than ever. This second source status is opening doors to new contracts and partnerships. They're also investing in software, making it easier for developers to switch and build on AMD's platform. By supporting popular AI frameworks and building robust developer tools, AMD is lowering the barriers to entry for companies and individuals looking to harness their hardware. This software push is critical for long-term adoption and ecosystem growth. The result? A growing ecosystem and a sustainable competitive edge. As more developers, researchers, and enterprises adopt AMD solutions, the network effect kicks in, making AMD's platform even more attractive and future-proof. Financially, AMD is strong, with a healthy balance sheet and the flexibility to keep innovating. The company's prudent management of resources means it can weather industry cycles and invest aggressively in new technologies without overextending itself. The risk: execution. The AI chip market is fiercely competitive, and AMD must keep delivering on its promises. Rivals are constantly innovating, and the pace of change is relentless. For AMD, staying ahead means not just keeping up but setting the pace in performance, efficiency, and reliability. But their track record inspires confidence. They've done it before in CPUs and now they're doing it in AI. AMD's history is filled with comebacks and breakthroughs, from the Ryzen revolution in consumer CPUs to their current push into data centers and AI accelerators. The market is just starting to price in AMD's long-term potential in data centers and AI. As more investors recognize the scale of the opportunity, AMD's valuation could see significant upside, especially as the company continues to execute on its ambitious roadmap. For investors, AMD offers exposure to the AI boom without the sky-high valuations of the current leader. While some AI stocks have already soared to dizzying heights, AMD remains relatively affordable, offering a compelling risk-reward profile for those looking to participate in the next phase of AI growth. The pie is growing fast. There's room for more than one winner, and AMD is set to be a key player. As the AI market expands, it's not a zero-sum game. Multiple companies can thrive, and AMD's unique strengths position it to capture a meaningful share of this explosive growth. Even a modest market share in AI accelerators could mean tens of billions in new revenue. This isn't just theoretical. Analysts project that the AI hardware market will continue to grow at a double-digit pace for years to come, and AMD is well positioned to ride that wave. That's why AMD is my first pick for a cheap AI stock, not cheap by PE, but cheap relative to its growth potential. The company's current valuation doesn't fully reflect the upside from its AI and data center businesses, making it an attractive entry point for long-term investors. It's a calculated bet on a proven innovator entering a lucrative new arena. AMD's culture of engineering excellence and its willingness to take bold risks have paid off before, and the company is now applying those same strengths to the world of AI. AMD currently has a market cap of $335.4 billion, with a price-to-earnings ratio of 108.43 and earnings per share of 1.90. In 2024, the company generated revenue of $25.78 billion and net income of $1.64 billion, showing steady growth in its semiconductor business. For long-term investors, AMD is one of the most compelling AI plays right now. With a strong leadership team, a clear vision, and a growing presence in the most important tech markets of the future, AMD is poised for continued success. Let's move to the next opportunity. Next up is Oracle, ticker symbol ORCL, a software and cloud giant that's been a foundational force in the tech world for decades, but is now quietly making a major push into artificial intelligence. While Oracle may not always grab headlines like some of its flashier Silicon Valley peers, its influence is everywhere, and its latest moves in AI are positioning it for a new era of growth. Oracle's databases are the backbone of global business, storing and managing the world's most critical data for everything from banks and hospitals to airlines and retailers. If you've ever booked a flight, checked your bank account, or even shopped online, chances are Oracle's technology was working behind the scenes to make it happen. Their customers are deeply entrenched, with years, sometimes decades, of business processes built around Oracle's software. This creates a powerful moat, making Oracle's position in the enterprise world nearly unshakable. Switching away from Oracle isn't just a software change, it's a massive, risky overhaul that most companies simply won't attempt. Here's where the AI angle comes in. AI needs data, huge amounts of it, and Oracle has access to some of the richest, most valuable business data on the planet. This gives them a unique advantage as AI adoption accelerates across industries. Oracle is embedding AI directly into their enterprise products, from databases to business applications, allowing clients to unlock powerful new features and insights using their own data. Imagine a company being able to forecast demand, detect fraud, or optimize supply chains, all powered by AI, and all within the Oracle ecosystem they already trust. For businesses, this means a seamless, secure way to adopt AI. No need for complex integrations or risky migrations. Oracle's approach is all about making AI accessible and practical for the enterprise, while maintaining the security and reliability that their clients demand. Unlike some tech companies chasing consumer AI trends, Oracle's focus is squarely on enterprise AI, solving high-value, mission-critical business problems. This is where the real money is, and where Oracle's deep relationships and technical expertise give it a major edge. But Oracle isn't stopping at software. They're rapidly building out Oracle Cloud Infrastructure, or OCI, which is designed from the ground up for high-performance AI workloads. This cloud platform is attracting not just big enterprises, but also AI startups and research teams that need raw computing power to train and deploy advanced models. This two-pronged strategy, AI-infused software for their massive existing client base and cutting-edge cloud infrastructure for the next generation of AI companies, means Oracle is positioned to win on both fronts. They're not just selling software, they're becoming a critical platform for the AI revolution. From a valuation perspective, Oracle trades at a reasonable price-to-earnings ratio, especially compared to some of the high-flying tech names. The company generates strong free cash flow, pays a solid and growing dividend, and regularly buys back its own stock, offering investors a rare combination of growth potential and downside protection. Yet, the market still tends to lump Oracle in with old tech, overlooking the rapid growth of OCI and the massive opportunity in enterprise AI. This disconnect creates an opportunity for investors who can see past the outdated narrative and recognize Oracle's transformation. Of course, there are risks. Oracle faces fierce competition in the cloud from giants like Amazon, Microsoft, and Google, and the company is still working to shed its reputation for being difficult to work with, as it shifts toward a more customer-friendly culture. But the transformation is real, and it's gaining momentum. Strategic partnerships are also a big part of Oracle's story. Their collaboration with Nvidia, for example, gives them access to the world's most advanced AI hardware, while their focus on sovereign AI, cloud regions tailored for specific countries and regulations, gives them a unique edge in markets that are underserved by other cloud providers. As OCI's revenue continues to accelerate and Oracle's AI capabilities expand, the market will be forced to reevaluate the company's growth potential. We're already seeing signs of this, with OCI's growth outpacing many competitors and new AI-driven products gaining traction. For investors, Oracle represents a fortress business, stable, resilient, and deeply embedded in the global economy, with a brand new high-tech growth engine that's just starting to fire on all cylinders. It's a rare combination of safety and innovation. In other words, Oracle is a value play with a powerful AI catalyst. As their strategy unfolds, investors could see steady, market-beating returns, driven by both the stability of their core business and the explosive potential of their AI and cloud initiatives. Oracle sits at a market cap of $66.63 billion, with a price-to-earnings ratio of 48.66 and earnings per share of 4.33. The company recorded revenue of $52.96 billion in 2024, producing net income of $10.46 billion, demonstrating strong profitability in its software and cloud services operations. If you're looking for AI exposure but want less risk than the high-flying volatile names, Oracle is a smart, patient bet. It's a way to participate in the AI boom without sacrificing sleep at night. With Oracle, you get blue-chip stability, a long track record of execution, and underappreciated growth potential that's just starting to be recognized by the market. That's why Oracle is my second pick, a quiet giant that's about to make a lot of noise in the world of AI. As the AI revolution accelerates, don't be surprised if Oracle becomes one of its biggest winners. Now, let's turn to the king of AI hardware, on to Nvidia. Finally, let's talk about Nvidia, NVDA, the undisputed king of AI hardware. If you've been following the tech world, you know that Nvidia isn't just another chip company. It's the company that's become synonymous with the AI revolution, the backbone of the most advanced computing on the planet. From humble beginnings as a graphics card maker for gamers, Nvidia has transformed itself into the most critical player in artificial intelligence infrastructure. Yes, the stock isn't cheap by traditional metrics, but value isn't just about a low PE. When you look at Nvidia, you're not just buying a number on a spreadsheet, you're buying a stake in the future of technology itself. The company's valuation reflects not only its current dominance, but also the market's belief in its ability to keep leading the charge as AI becomes more deeply embedded in every industry. Sometimes you pay up for the best, just like you'd pay more for a luxury car or a top-tier smartphone. Investors are willing to pay a premium for Nvidia because it's the gold standard in AI hardware. The price tag might seem steep, but it's a reflection of the company's unmatched quality, reliability, and innovation. Nvidia's GPUs are the engine of AI, powering everything from chatbots to self-driving cars, whether it's training massive language models, running real-time image recognition, or enabling autonomous vehicles to make split-second decisions. Nvidia's technology is at the heart of it all. Their chips are the workhorses behind the scenes, making the impossible possible. Their dominance is staggering. Over 90% market share in AI training chips and a software ecosystem, CUDA, that's become the industry standard. CUDA isn't just a tool, it's a moat. Developers, researchers, and companies have built their entire workflows around Nvidia's platform, making it incredibly difficult for competitors to catch up or for customers to switch away. Switching away from Nvidia is costly and complex, making their position nearly unassailable. The infrastructure, the code, the expertise, all of it is deeply tied to Nvidia's ecosystem. For most companies, the cost and risk of moving to a different platform is simply too high, which only strengthens Nvidia's grip on the market. Every major AI build-out means billions flowing to Nvidia. They're not just selling picks and shovels, they're selling the only mining machines that matter. When tech giants, startups, and research labs need to scale up their AI capabilities, Nvidia is the first, and often only, call they make. The company's hardware is the foundation upon which the next generation of technology is being built. Despite a high PE, Nvidia's explosive growth keeps outpacing even the most bullish forecasts. Quarter after quarter, the company delivers results that leave analysts scrambling to revise their estimates upward. It's not just about beating expectations, it's about redefining what's possible in the tech sector. The AI revolution is just beginning, with trillions in potential market size over the next decade. As AI weaves itself into healthcare, finance, manufacturing, and entertainment, the demand for Nvidia's products will only accelerate. We're talking about a tectonic shift in how the world works, and Nvidia is positioned at the epicenter. Nvidia's relentless innovation, annual product cycles, constant upgrades, keeps them far ahead of competitors. CEO Jensen Huang and his team have built a culture that's obsessed with pushing boundaries, whether it's through new chip architectures, software breakthroughs, or partnerships with the world's leading tech companies. They're not just hardware, they're a full-stack AI platform from chips to software to pre-built models. Nvidia's reach extends from the data center to the edge, from cloud computing to robotics, and even into the world of creative content and simulation. Their ecosystem is so comprehensive that it's become the default choice for anyone serious about AI. Risks? Sure, high expectations, fierce competition, and geopolitical factors. The chip industry is notoriously cyclical, and global tensions can impact supply chains or market access. But Nvidia has shown remarkable resilience, adapting to challenges and finding new ways to grow, even when the odds seem stacked against them. But demand is overwhelming, and Nvidia is the primary arms dealer in the global AI race. As governments and corporations pour resources into AI, Nvidia's chips are the essential tools everyone needs to compete. In a world where technological supremacy is the new arms race, Nvidia is supplying the most advanced weaponry. You're paying a premium, but you're getting a near monopoly in the most important tech shift of our lifetime. The company's dominance isn't just a temporary advantage, it's a structural one, built on years of innovation, strategic investment, and a deep understanding of what the future needs. Their financials are mind-blowing, huge margins, massive cash flow, and the ability to keep investing in R&D. This isn't a company that's resting on its laurels, it's one that's using its financial strength to widen the gap between itself and the competition, year after year. Nvidia is with a staggering market cap of $4.4 trillion. Its price-to-earnings ratio is 44.60, with earnings per share of 4.05. In 2024, Nvidia posted revenue of $60.92 billion and net income of $29.76 billion, highlighting its dominance in AI chips and graphics processing technology. For investors wanting pure direct exposure to the AI build-out, Nvidia is the main event. It's the stock that gives you front-row seats to the most exciting technological transformation of our era, with the potential for enormous returns as AI adoption accelerates. AMD and Oracle are great strategic plays, but Nvidia is the sun, around which the AI universe revolves. Every major player in the space, from cloud providers to autonomous vehicle companies, orbits around Nvidia's technology and innovation. It's a bet on continued dominance and a technological revolution that's just getting started. If you believe in the future of AI, it's hard to find a more compelling way to invest than through Nvidia. Sometimes the best isn't cheap, but it's worth it. Nvidia's premium price is a reflection of its premium position, and for many investors, that's a trade-off worth making. Nvidia is the ultimate growth stock for the AI era. It's not just about today's profits, it's about owning a piece of the infrastructure that will power tomorrow's breakthroughs. You're not just buying a stock, you're buying a piece of the future's foundation. As AI becomes the backbone of the global economy, Nvidia's role will only become more central and more valuable. That's why, Even at today's price, Nvidia is a cheap stock relative to its potential. For those who want to be part of the next great technological wave, Nvidia isn't just an investment, it's a statement of belief in the future. Let's wrap up. So, there you have it. 3 distinct ways to invest in the AI revolution: AMD, Oracle, and Nvidia. Each offers a unique risk-reward profile, but all are positioned for long-term growth. The key is knowing which story fits your portfolio and your view of AI's future. Want deeper analysis and real-time trade alerts? Join the Stocks Galore Patreon, link in the description. Now, I want to hear from you. Which of these 3 stocks do you think has the most upside over the next 5 years, and why? Drop your thoughts in the comments. Don't forget to like, subscribe, and share for more smart investing content. Thanks for watching. I'll see you in the next one.